Hello, good morning. My name is Richard Cowley. I'm a director at RM2, and welcome to our presentation on the practical tips for a successful EOT. Just a little bit of housekeeping to start off with. This presentation should last about 45 minutes. We are hoping to have some time for questions at the end. If we run out of time, i.e. we just present the slides, what we'll do is we'll take the questions that you submit and we will answer those offline. In fact, we never have enough time to sort of answer all the questions anyway, so we will do this anyway. It does mean that if you have any confidential questions, please mark them as confidential so we know not to sort of broadcast your questions to everyone else. I'm with my colleague John Besant. We're very happy to take any sort of contacts directly. You'll see our email addresses at the bottom of the screen. We're also recording this webinar and it will become available on our website, rm2.co.uk. Take care. There is another company which has got rm2.com. They supply pallets. We are the company that doesn't supply pallets. It also comes on our YouTube channel if you wanted to go via that way. So what we're trying to do with today's webinar, in the past we did introductions to EOTs. This time we kind of think there's a lot of information out there in terms of sort of the basics on EOTs. Now we are going to cover those, but we're going to cover them at speed. And what we want to try and get through is sort of more of the practical tips and consequences and things you need to think about if you're contemplating an EOT transaction. This is the information is more difficult to get from the internet, and therefore we thought it would be more useful for you guys as listening. So we're going to just move into, as I said, we'll have a quick introduction to EOT transactions, but it'll be very, very quick. And then we get on to the practical considerations when you're doing an EOT transaction. Right, just a quick sort of background in terms of our EOT transactions. They came into being via government legislation 2014. Since when, there's been more than 1,500 transactions, but it's still really small numbers. But there is just a general sort of momentum upwards. It's increasing significantly year on year. I don't think we're that far away, probably next 5 or 10 years when EOT transactions will be very mainstay, very normal for people to sort of sell their businesses or exits. We've got the pictures in terms of some of the companies which are EOT owned, these are kind of the poster boys in terms of companies. John Lewis is there. Obviously, they set their trust up over 100 years ago, and actually because they are the model for the legislation which took place, they became an EOT officially back in 2014. Since then, we've had companies like Riverford, Organic Farmers, Aardman Animations, Go Ape, Take That Plunge. These are the poster boys. These are the high-profile type companies which are employee-owned or EOT-owned. They're not really representative of the normal type of companies which are doing this. Normal type of companies which are doing EOT transactions are much smaller. SME-type businesses which have valuations sort of 2 to 10 million. There are some transactions which are much bigger, and there are transactions which are much smaller. Most companies can do EOT transactions, but we just kind of like to sort of show you're not alone, and there's some big numbers, big names out there, which are the poster boys. Right, I'm just going to go very basically into what is a employee ownership trust. So employee ownership trust is a trust which is set up specifically to buy a business from a shareholder. So it's taking a controlling interest in a business. And it is an employee ownership trust because the beneficiaries of the Trust has to be all employees of the business. As I said, it was set up by legislation. It was set up because the government thinks employee ownership is a good idea on the basis that if employees own their business, they get more engaged, they work harder, it increases productivity across the economy as a whole. It's a good thing. And actually, the evidence since 2014 is that businesses that do become employee-owned do actually increase their productivity and engagement in general. So because the government set this up, because the government thought it was a good idea, they said, actually, we need to incentivize owners to do this, and this is where your capital gains tax relief comes from. It means that people who sell their businesses to a employee ownership trust get 100% relief on capital gains tax. They get their money tax-free. This tends to be the sort of headline in terms of why people do EOT transactions. In reality, it is not the reason that people do EOT transactions. There's lots of really good reasons above and beyond the capital gains tax, although the capital gains tax is obviously a nice thing to have, which we'll touch upon in one of the later slides. There is a second tax relief in that as soon as you've done the transaction, you are able, literally the day after, to pay your colleague bonuses that are tax-free, up to 3,600. There are particular conditions attached to how those are paid. Effectively, they're not discretionary bonuses. Everybody has to get something, but they don't have to get the same amount. National insurance still is payable. So I am now going to hand over to my colleague, who is just going to start taking you through a little bit more detail about the trust.
So hello, and again, welcome to our webinar this morning. I'm John Besant, and I work alongside Richard as part of the EOT team here at RM2, mainly delivering EOT transactions for clients. I've led over 30 transactions over the last few years. As brief background, before Richard talks more about the practical considerations, I've just got a few slides to remind us about the key legal requirements for an employee ownership trust, highlighting a few of their key advantages and disadvantages, and a typical timeline for an owner-manager considering succession and exit, comparing EOT with a trade sale, which is the most common comparison. So there are really only 5 legal requirements for a qualifying EOT, which are set out in the legislation. In a way, we're quite lucky to have such a light touch legislation, and it hasn't been updated since its inception 10 years ago. The government did publish a consultation last year, which drew a significant response from the EO sector, but no changes have yet been slated. And if there are any changes, we're not expecting anything significant reform in this area. So in general, as long as these 5 requirements are met, then the capital gains tax relief will be given, and employees will be entitled to a tax-free bonus. However, importantly, if the requirements are breached, then capital gains tax relief will be clawed back, either from the sellers until the end of the tax year following the transaction, and thereafter from the trust. So the first 2, the all-employee and equality requirements, they're fundamental to the principles of employee ownership. The EOT must be for the benefit of all employees. They're actually beneficiaries, but it's for all employees, and on what the legislation terms, on the same terms. I'll touch on that in a second. These will be baked into the trust deed, which governs the way that the trust is operated. However, because the trust simply holds the shares on behalf of the employees, these requirements only largely impact if the trust at a later date sells the shares and distributes proceeds to its beneficiaries, who are the employees. If the trust is to distribute funds to the employees, and it doesn't do that on an equal basis, then it can only differentiate based on people's pay levels, similar to John Lewis model, where everyone gets the same percentage of salary. It can do it make distributions based on length of service to reward those colleagues who have served the business longest, or they can be based on hours worked. If they choose to, the trustees can use a combination of these criteria added together. Importantly, the all-employee requirement means that you must make payments to all employees. Trustees are unable to just discriminate based on other factors, and distributions can't be made based on employees' performance, whether good, bad, or indifferent. A long-serving senior full-time employee will always fall top of the pile in these calculations. It's the same rules for paying an annual tax-free bonus of up to £3,600 per employee per year, although that's a decision for the company's directors, not the trustees, who merely need to confirm that the rules have been followed. The class of beneficiaries is generally all the employees in the business from time to time, but there can be qualifying criteria of up to 12 months service for new starters, and there's a few special rules for disciplinary cases and leavers. Also, without getting too technical, former and current shareholders with more than 5% of any class of share are what's known as an excluded participator, and they can't benefit from a distribution from the trust, although they are entitled to a tax-free bonus should the company pay one. The trading requirement simply means that the EOT business must be a trading business or the holding company of a trading group. And there are just a few exceptions, such as property holding companies that can't be EOTs. Ceasing to trade presents a company with a myriad of difficult problems, and ceasing to meet the EOT rules may well be some way down that list. The controlling interest requirement is the most likely to be triggered if the trust sells its shares in the future. Put very simply, the trust must always control the company and hold more than 50% of the shares, 50% of the rights to profit, and more than 50% of the assets on winding up. So there are no clever ways around this with different classes of shares and different rights. Finally, the limited participation requirement stops some small family-owned companies from becoming EOTs. The number of shareholding employees and their relations can't be more than 40% of total employees. Now, there's potentially a legislation drafting issue here in that shareholding employees includes anyone owning more than 5% of any class of share. This can produce unintended consequences for companies with established share schemes and is a trap for the unwary. You'll need to comply with the limited participation rule for 12 months prior to the EOT transaction and at all times whilst an EOT. So just be aware of that if you're a smaller business and you're using a share scheme after the EOT. Now, just a brief slide on the key benefits of selling to an EOT. I think these can all be summarised basically as you don't have to sell your business to anyone else. It's one of probably the most gentle methods of selling your business, and to be honest, that's most of the attraction. So as a seller, you should get fair value for your shares, and you'll get 100% capital gains tax relief as an encouragement to sell into the EOT structure. You don't need to approach potential sellers, prostitute yourself to the market, agree heads of terms, endure third-party due diligence, and then enter into a detailed, sometimes combative negotiations and price chips before finally signing a 200-page share purchase deed with 100 pages of disclosure at 2 AM at the lawyer's offices, which I've done in the past. And then you don't have to endure an earn-out period of several years after the deal where you're no longer calling the shots. We'll leave all of those to companies who want to pursue a trade sale. An EOT is a seller control process, and the beauty is that the company remains largely unchanged. So there's no new owners taking charge, changing strategy, making redundancies and moving head office. Simply a gentle change of control, with employees slowly starting to take charge of their own destiny whilst you step back from the business at a time and pace that suits you. And I'm sure by now you know about the tax reliefs, but they are an incentive to sell into the EOT structure. In our view, the benefits which I've just talked about actually outweigh the tax release, which are merely icing on the cake. So I've known a very senior partner in KPMG for many years, and he was recently involved in a share sale to an EOT. And he asked me a very simple question. He said, "John, this seems too good to be true. What is the catch?" Well, the simple answer really is that if you're prepared to wait for your capital to be repaid and you're confident in the business's profits and cash flow to be able to repay the debt, with or without you remaining at the helm, there really is no catch. However, given that most of the sales value is likely to be based on deferred debt payments owed to you, then it really is the sellers who take all the risk in an EOT transaction. One of our clients used the phrase which I really like, which was, an EOT is a deferred gift to the employees. It's deferred because the business needs to repay the debt before its full profit share, but it's a gift because they pay nothing for their indirect share in the EOT. Now, it is a really important point that an EOT does not solve any succession planning issues, although it can be a key step in succession planning. All the businesses we meet are different here. Some have internal succession lined up and plan to exit their business reasonably soon after the EOT transaction. Probably the majority have likely internal succession identified and will implement the plan during the debt repayment phase. And some know that they'll need to identify or possibly need to recruit succession after the EOT sale. We've seen several clients successfully recruit post-EOT based on the future prospects of the EOT being so attractive for incoming management. Now, all of these approaches are valid. You simply need to know that you need to have a plan, and its success or otherwise will likely determine your exit timescales from the business. It's key that you get your colleagues to buy into the medium-term plan, and it's very important not to overpromise and under-deliver. Profit sharing will be really, really rewarding for the team, but the business needs to repay you first. Finally, a consequence of selling your shares to any third party is an exposure to inheritance tax. But a consequence of selling your shares to an EOT, where the debt will be repaid over a number of years, will require careful IHT planning if the worst should happen. Finally from me, this slide just sets out the very different timescales of a traditional sale versus an EOT sale. If you're planning to exit your business at, say, age 65, then with a trade sale, you think about preparing the business for sale, optimizing profitability, implementing long-term customer contracts, and tidying up in general for several years before the sale. So probably starting from an age of maybe 58. When you're ready and you appoint expensive advisors, the sale process starts. As soon as you get going, you'll need an information memorandum. Then you'll undertake beauty parades to the market. You'll select a buyer. You'll have to be subject to detailed due diligence, and you'll negotiate further on the deal, and then you'll be into the legals. This can easily take a year to 18 months or longer, and it can suck the life out of you as a seller. I've seen many business owners take their eye off the ball of trading during this deal phase, and there's always the execution risk of the deal not happening at all. After the deal, there's likely to be an earn-out period, which may or may not be enjoyable before your eventual exit. Compare that with an EOT sale, which is so much easier. There's much less upfront time, as Richard will go into, and the actual transaction is as stress-free as we can make it for you. You'll likely do this much earlier in your exit timetable, and you'll stay with the business, implementing your succession plan whilst being paid both market salary and your deferred consideration, and then you'll step back from the business at the time that suits both you and the business. Now, I accept this is a very simplified model, but having led a few third-party sales and over 30 EOT transactions, I've got a firm preference between the two. I'll leave you to guess which. Now, I'm really, really aware that I've cantered through a lot of fundamental points in the last few slides, and for the purpose of this webinar, a lot of that is taken as read. We're clearly more than happy to spend time with any of you going through these points at a more leisurely pace. Please just let us know and we'll get in touch. So now I'll hand back to Richard to talk about some more practical tips on making your EOT a successful one.
Thanks, John. Right, we are going to go into a number of sort of what we think are the key sort of considerations that people have to do in that practical process that you should go through, as well as the sale process. So they cover valuation, the role of the trustees. Post EOT means what happens after the EOT happens. 100% or less means, okay, so the trust needs to own the majority shares, 51% at least, but that means that the current owner can keep some shares, and we'll go into sort of the implications of that. Pure and hybrid means if you're going to sell 100% of your shares to a trust, is anyone else at a later stage going to own any of those shares? So the pure model for EOT is 100% owned by the trust. Hybrid is that somebody else owns shares. And staff communication, it's obviously something which shouldn't be forgotten, and there is kind of good ways and bad ways of talking to your staff about the transaction which has happened. We should have mentioned a couple of things as part of the housekeeping. RM2 are speaking to you not just as advisors on EOT transactions, but we've actually done it ourselves. We are a living example of an employee-owned business, and we are in the happy position that our that our previous owners have all paid off, so we've gone right the way through to profit share, and it's worked very well for us. Also, you can, as I said, we are cantering through, especially the first bit. We are happy to send out copies of the slides after this presentation, if you so wish. Again, please get in touch with either me or John. Right, so we're going to move into practical considerations. So the first one is valuation. Obviously, really important in terms of doing an EOT transaction is how much is the trust going to pay for the company. So many of our competitors will basically go down the route of getting the first thing they do is go down and get a valuation from a formal valuation from a value of companies, and it will predominantly usually be some kind of multiple of historic profitability. It's not the way we do it because we're not sure that that's the right way to do a valuation. Hasten to add that this is the RM2 version of valuation of a company for an EOT. So a company is worth for an EOT transaction what it is able to pay for itself. You think about the transaction. So owners are selling their shares to a trust. They will do that quite quickly. As John says, you were talking about you can be done and dusted 3 months after you even sort of start talking to your advisors about a transaction. The trust is set up specifically to buy the shares. It has no funds on its own account in order to pay the shares. So when it first buys them, it's writing a very big IOU to the selling shareholders. It then relies on the company to pay for those shares out of cash assets which are already in the company, and then over a period of time, the profit or the cash which is generated from the company. As a result, we believe that your company is worth what it can afford to pay for itself at the point of the transaction. It means that our approach to valuations is effectively to create a cash flow model for the next sort of 5 to 10 years. Valuations are very subjective, as you can imagine. They're very subjective whether you're doing a multiple of EBITDA or a multiple of profitability or doing a cash flow forecast. But because we are using cash flow forecasts, we want an indication of the increased turnover, the increased profitability of a company. We need to engage the owners and we need to engage the company's management, maybe the same person, of course, in terms of building that valuation. It means that our belief is that owners must input to the valuation of the companies. So it's not good enough to basically go off and get a formal valuation and just deliver it to owners and say, right, that's the most you can pay for your company. Owners need to be involved in it because they need to build expectations in terms of valuation. It also allows owners to understand the transaction a lot more because they can see, actually, this is how the valuation is constructed, and this is the expectations on the profitability of the business going forward, and this is my expectations on the timing on which I'm going to get my money out of the transaction. We think this is fairly obvious, but we think we're quite unusual about how we do valuations. But it is a very key thing to understand. Your business what you receive from an EOT transaction is limited by what cash can be generated from the company post-transaction. And that's a very important fact to understand. The last point is that as well as the cash which is generated from the company after the transaction, you can also take cash out of the business as part of the capital transaction, which is already in there at the point of the transaction. Now, compared to a third-party transaction, it's often the case third parties buying your business, they say we're buying it on a nil cash, nil debt basis. that's the situation, which is normal. It means that owners need to take surplus cash out of the business before the transaction takes place. It comes out as dividends. It is taxed as income. As a result, a very big benefit of doing an EOT transaction is that surplus cash can be taken out as part of the capital valuation. It's therefore subject to capital gains tax, of which you're paying none at all because you've got 100% relief. So whereas the normal sort of capital gains tax relief will cut your tax bill from 20 or 10% to nil, this element is cutting it from 45% to nil. Obviously a significant benefit. Right, it's something that we're now in a sort of stage with EOT transactions that we're kind of meeting lots of people who've been through transactions. And one of the more common comments that people say to us is like, well, we've done the transactions, but we've no idea what trustees are actually supposed to do. It's a pretty grey area. If you Google sort of role of trustees on an EOT transactions, you will see a number of different scenarios. Again, you're getting the role of trustees according to RM2, but we like to think that actually this is kind of what's seen as best practice by those advisors who are more sophisticated than some of the advisors are. So the role of trustees. This is something which owners should be really sort of wary of, because up until a transaction, when you're owning the business and you're running the business, effectively you are a dictator over that business. There is nobody out there who can tell you what to do. As soon as you've sold your shares to a trust, and the trust will have trustees, because the trust is a legal entity, it can't speak for itself, so you'll set up trustees who will speak on behalf of the trust. And they have significant power. They can tell you as a manager, you're now no longer an owner manager, you're just an employee manager, and you may be a director of the business, but the owners can actually tell you what to do. However, this is not really what happens. So trustees must make decisions which are in the best interest of their beneficiaries. Directors should be making decisions which are in the best interest of the company. So what is in the best interest of beneficiaries is that the company is run in the best way possible. Well, that should be exactly what directors are doing. Trustees kind of it's a very part-time role. They haven't got the time. They shouldn't have the inclination to run the business themselves, and therefore, the company directors, which is usually the previous owners, will retain the authority to run the business. And there's only a sort of a partial looking over the shoulders of directors by trustees. In other words, effective operational control stays with the directors of the business, which generally is the owners for at least a period after the transaction. It means that trustees, they do have significant control. They can remove, they can appoint new directors, they can raise special resolutions, they can effectively veto board decisions, but they don't do it because they have handed over the ability to run the business. They have confirmed the authority of the running the business stays with the directors. It means that trustees' role should be friendly and supportive to the company board. Owners who are selling their businesses to trust should not fear that they are basically going to have to take instructions by some trustees who don't understand the business as well as them. That simply doesn't happen. So, when you think about doing an EOT transactions, you'll be very focused about the process of basically the legal process of transferring ownership over to the trust. We think that you should also spend a fair amount of time just understanding how you are going to approach life post-transaction. What happens after the ownership moves to the EOT? Now, one of the big benefits, as John stated, is that when you move from owner-managed business to EOT-owned business, it's very gentle on the business. There's no obligation for directors to change. There's no obligation for the management team to change. In fact, we kind of encourage that actually the day after the transaction is best for the business if it's just business as usual. But we think it's important that people do have a vision on what is going to happen. It is kind of your exit plan and your succession plan. So even if it's kind of a very high level element of it, because obviously after the transaction, owners will be repaid, and a good majority of owners stay in the business for at least a good portion of the time that it takes them to be repaid. They have time to put succession planning in place, but it's very useful that they kind of have a generic idea of what it's going to look like, what the business is going to look like after their exit. Because there are elements of the EOT transaction that can be designed to facilitate the succession planning and reinforce succession planning post-transaction. Also, thinking about how your business will look after the EOT. I mean, obviously, it's kind of part of your exit process, but it's also part of actually preparing the business and your colleagues for the actual exit, where the reins are properly handed over to the next generation of directors and your colleagues take up the reins. It also allows you to sort of understand, and there's a slide later on about communication to staff. It gives you the basis on which to start talking to your colleagues. We're very keen on people who, when they start talking to their colleagues, they're very considered about this, because you can get into trouble if you start saying, well, this is really good news, business has been sold to a trust, you are indirect owners of the business, there will be profit share, but there will be profit share in 5-6 years' time. Some of your colleagues may be very turned off by that, because they say, well, I can't even think that far ahead. That means nothing to me. I don't know why you're even telling me. So it's all about sort of considering what employee ownership means to your colleagues, and in particular for key staff, what is going to incentivize them, what is going to motivate them to step up to the position of taking over the reins from the founders and owners. And as I said, there are tools that can be used in association with the EOT which helps in that. We are often asked by owners when they come and talk to us, in fact, they often sort of have the idea that they're going to retain some ownership. As we said, the business needs to be majority owned by the trust. It doesn't need to be 100% owned by the trust, so owners can retain some equity. We always challenge owners who come with that sort of idea, is that, well, okay, you can absolutely keep some equity, but have you thought about the fact that you may be just kicking a bit of a can down the road, because ultimately at some point you're probably going to want to offload your equity. And there's nothing wrong with that, but you probably need to sort of consider a few things which will change if you actually keep a minority shareholding. So the first reality that needs to be considered is when your capital gains tax relief, it only happens once. It happens in the tax year in which the control passes to the trust. After that, you've still got to pay capital gains tax. You can still use business asset disposal relief, the old entrepreneurs relief, but you're going to have to pay tax. Because the business is being bought by the trust for debt, it does mean there's kind of a paper devaluing of the business. It's only paper devaluing. It doesn't really make a difference to the business, but it would make a difference to anybody trying to sell those shares, because you've kind of got your enterprise value, your goodwill value, which is reduced by debt. that the business is obliged to pay, which is the vendor debt. So by association, the equity which is retained by the shareholder reduces in value. More important, just as importantly, it's also become a minority interest. And I'm sure most of you have heard of sort of minority interest discount. Shares which are in minority are just not worth as much as shares that give people control over a business. And therefore, they should be aware that there could be a reduction in the value. There are things in legal documents that can be done to protect vendors' interests in this, which we kind of hook into if we have a vendor who says, yes, no, I want to retain a minority interest. But if you don't have those protections, you are exposed. It's equally, if you're expecting at some point in the future to sell your final tranche back to a trust, and you have reasonably sophisticated trustees, you could be in trouble. Trusts do not take dividends from companies. So if you're going to say, right, I've got my remaining 20%, I now want to sell it, trustees, can you buy my shares? And they say, well, yeah, we'll think about it, but we don't take dividends, so it's not going to increase our dividend income, and we already have control. So they're not really worth very much to us, so we won't pay you very much for them. Again, you need a bit of protection in order to stop that from happening. You need things set up, and it's a quid pro quo. I'm selling my shares on the understanding that at some point in the future I will sell my remaining tranche. Just one sort of remaining idea, and this is something I've personally come across a number of times previously in when I wasn't doing employee ownership. I've come across owners who sort of retained stakes thinking that they were going to get a nice little income into the future to cover them from pension, and they'll leave it to their kids and they'll get a nice income. This is never a good idea in privately owned companies. At some point, the next generation or even the generation after that in directors, they're going to get a little bit frustrated by the fact that they're expected to hand over profit, their hard-earned profit, to people who are not really making any contribution to the business anymore. It's particularly dangerous in an employee-owned business which does profit share, because profit shares reduces the amount of profit which can be distributed to shareholders. It's very easy to not have enough money in an employee-owned business to pay shareholders. Right, next slide. Leading on to actually, so we've had owners retaining a shareholding, and now we kind of say, well, actually, the trust doesn't need to own all the shares. It means that share schemes work particularly well on EOT transactions. And this is going right the way back to sort of mention that you can design the transaction which will help you with your succession planning. If you have you may have ambitious key staff who even had desires on actually owning the company as a whole. If you then announce to these people that actually you're selling the company to a trust where ownership is shared across all their colleagues, it may not fit into their own personal objectives. This is where you may consider actually setting up a share plan. It is going to give the next generation of directors, your key staff, skin in the game, an additional bit of motivation and incentivization to stay at the business. You are trying to handcuff these guys to the business. Share schemes work particularly well in an employee-owned scenario because of this paper devaluation of the business. Sounds very negative. It is a fantastic opportunity to sell equity to some of your colleagues. So they're supercharged share schemes. Whereas normal share schemes, you may be giving sort of 5% of the company away. This is you've got up to 49%. Don't recommend going straight to 49% because you kind of run out of road, but maximize out with 40% maybe. But it's a meaningful level of equity to get your key guys to stay within the business. doesn't work for sort of pushing it across everyone. And it works extremely well. It gives your colleagues, your key colleagues, the ability to have enhanced profitability because they're paid partly because they're owners and partly because they're employees via profit share. Just as importantly, it is the only way that they can easily get a capital gain out of employee-owned business. Beneficiaries of trusts can get a capital gain, but the entire business has to be sold in order for the trust to have funds to then allocate to their beneficiaries. If you own your own shares, you leave the business, you'll be obliged to sell them back to the business. Terms and conditions will be attached to them, but it gives you an easy way to get a capital gain. Like we mentioned before, key understanding, kind of covered this very well already, but yes, re-emphasize, be considered about how you actually talk to your colleagues about transaction, how you engage them into the future. As well as being able to sort of exit the business in a very comfortable and gentle way, you kind of may wish to sort of go for the employee ownership premium, which is basically getting your colleagues to actually have more engagement. This, in order to, I mean, this is a more difficult thing to do. It's what all employee-owned businesses strive for, and all of them are working out. You know, the John Lewis's, the Mark McDonald's, they are all working on this continuously, and they never get to the complete utopia. But you get close to it by understanding what employee ownership means to your colleagues, and building that plan from day one will help a lot. Don't overpromise. We've met people who've literally resigned from businesses which have become employee owned because they kind of felt that a whole load of promises were made, and it became evident that actually they couldn't be delivered because there was this sort of period of payback. There's lots of really good stuff about EOT transactions that you don't need to overpromise. It works for your colleagues as well as the exiting owners. And you have that time period after the transaction where the business can gently move into its next phase. You can have an evolution rather than a third party, big bang, new owners, new way of doing things, maybe new locations, maybe redundancies. There's not the revolution of a third-party transaction. There's a nice evolution where you can adjust things over time. But it's good to have a plan from day one. It might evolve. It's good to have a plan from day one. Right, I'm going to hand back to John. This is all the practical considerations. There's a lot more we could talk to you about. Again, you Pete, give us a call. Get in touch if you want us to have a further conversation.
So thanks, Richard. I appreciate we're butting up against our time, so I just wanted to briefly summarise some of the key takeaways from what we talked about over the last 40 minutes or so. So an EOT transaction is very much a seller-controlled process. You can structure a deal that works for you at a pace also that works for you. There's no negotiation with any third parties, and in most situations, there's just one law firm advised on the deal to get you into an EOT structure. As Richard outlined, there is flexibility around valuation, and this is very much a forward-looking valuation rather than backwards-looking, focusing on what the business can afford to pay over a reasonable timescale. This will be a very much an iterative process in which you will be very much involved. But it's really important that the valuation is reasonable and not too strong, otherwise you'll struggle to get buy-in from your colleagues. As always, begin with the end in mind. You should have a very clear strategy about the next 5 to 10 years, including management succession and how to retain and incentivise your key colleagues, especially during the debt repayment phase. Perhaps through partial profit share during the debt repayment period, perhaps through use of a share plan post-EOT, or possibly through a combination of both. On occasion, it can be appropriate to retain a shareholding, as Richard discussed, but we're going to challenge you around that. As we've seen many issues in those early EOTs, not necessarily RM2 advised, where former owners retain shares and have now left the business, but are still expecting to be paid dividends, and they're also potentially exposed around the valuation and exit of that residual shareholding. Finally, it's crucial to consider the right mix and the right individuals who will form your initial trustee directors. Given that sellers to an EOT do take most of the risk, it's entirely appropriate that you select these initial trustee directors. And these can be changed at a later date, perhaps when the vendor debt has been repaid, and colleagues may be at that stage in a position to elect their own trustee directors. Also, choose your advisors carefully. We're obviously very biased here, I'm afraid, but there's recently been a proliferation of advisors in our space, given the growth of EOTs. But there's only really a handful of advisors who are truly experts on EOTs. We've got an expert team within our M2 where EOTs are all that we do, all day, every day. And for our clients, this is a one-off transaction, and your choice of advisors shouldn't be a decision based purely on cost.
Okay, well, that's the end of it, and what I suppose we've run out of time for questions, but please, what we'll do is we'll keep the portal open. If you have any questions, just jot them down, and we will send a response within the next sort of, well, before the end of the week. We'll send them to everyone, so please mark if you do not want your question to be sort of aired in public. Also, reminder, our email addresses are there. Please, please, please get in touch. We are very generous in terms of pre-engagement advice that we take, and we will be happy to sort of talk you through any of the detail of this webinar in a little bit more of a leisurely pace. Okay, so that's it. Again, thank you for your attendance. I hope it's been useful. I hope you've enjoyed it, and yeah, hopefully speak to you again.
Thanks and have a good afternoon.